Welcome, everybody. My name is Rob Danino. I'm principal of Precision Benefits Group. And I want to thank you for coming today to discuss what we consider to be a very effective cost containment strategy as it relates to medical spending. It involves pairing a high deductible health plan along with a HSA or HRA banking arrangement. Now, it's effective for two reasons. One is obvious. It saves overall spending dollars for the employer and employee. And the second is that it fosters consumerism as it relates to medical spending throughout your employee population. So this is important no matter how big your company is, but the bigger you get, it's more important because the more people that understand how medical spending works keeps your overall premiums down. So without further ado, I'm going to introduce Harry Bickle, who's our senior consultant here at Precision Benefits Group. One last thing, if you have any questions, just pop them into the Q&A and we'll either answer them online or we will answer them live. So, Harry?
Thanks, Rob. Good morning, everyone. As Rob mentioned, my name is Harry Bickle. I'm senior benefits consultant here at Precision Benefits Group. And as Rob was mentioning as well, this strategy has been gaining some popularity, not only with our current clients, obtaining new clients, as well as introducing this to current clients as something different and unique out there that a lot of consultants aren't necessarily showing because it's a little bit confusing. And this definitely requires some education. So hopefully this will give you some good groundwork as to how this strategy works and how it could potentially save you, your employer some money, as well as your employees, how you can enhance their benefits program. So first, I'd like to start out by saying there's a ton of acronyms in the insurance business. There's even several more that aren't listed here. We could probably have a whole presentation on just acronyms alone. But I figured for the purpose of this program and strategy, I thought it would be good to kind of go over those acronyms as I may be referencing those acronyms throughout the presentation. So the first one here is HDHP. That stands for High Deductible Health Plan. Typically we're seeing these types of plans with at least a $2,500 deductible or more, sometimes a bit less, but that seems to be the sweet spot as it pertains to high deductible health plans. The next acronym, HSA, Health Savings Account. This is basically a glorified checking account that is often paired with HDHPs. And we see a lot of employers that offer these types of programs and just have the employees contribute to their own HSA checking account. HRA, that stands for Health Reimbursement Arrangement. And that's what we're going to be talking a lot about today in this program and how they work in conjunction with high deductible health plans. TPA, that is a third-party administrator, and they're involved in making and having everything fluid and working together between the insurance company and the employer and employees as it relates to this program. And lastly, EOB. This is the explanation of benefits, and this is one of the most important pieces that's affiliated with this type of program. And this is something that employees need to be educated on how to use these and how you get reimbursed. How you get reimbursed with utilizing your explanation of benefits. So how does an HRA work? A health reimbursement arrangement allows employers to reimburse their employees for medical expenses. Contributions are tax deductible for the employer, and only employers can fund HRAs. The money is only dispersed to employees when a qualifying medical expense is submitted, and any unused funds are kept by the employer. We're going to go into this a little bit more in detail, but this is really the win-win for this type of program, because a lot of times we're seeing that a lot of members aren't going to the doctor that often. And the upside for the employer is they're only reimbursing those employees when they are utilizing a qualified medical expense or seeing their primary or specialist or whatever the case might be. They're utilizing their health plan. So let's get into the nuts and bolts of the strategy, and it's really creating a win-win for both the employers and employees. And that is because instead of covering the premium dollars of a higher cost plan, a higher cost medical plan, we're recommending employers to take a look at a lower cost option and make up for it, for the difference with the HRA health reimbursement arrangement. So instead of looking at one of your standard type plans that we see a lot in the marketplace, maybe a 20, 25, 50 copay for primary and specialist and very little deductible or no deductible at all, we're saying, hey, let's take a look at maybe a high deductible plan and pairing it with this type of strategy and explaining to them and to the employees on how it's beneficial. So this way, you're not sticking employees with a huge deductible in the event that they go to the doctor. So if you look to go to a lower cost option, that might be great. But there comes, change with that, and the change being a higher deductible. So despite the exposure as an employer, employees only get reimbursed in the event that they use the health coverage. And if an employee leaves, they're not entitled to that balance as they would be with an HSA checking account. So sometimes we're seeing, as I mentioned, an employer may roll out one of these high deductible health plans to help offset the cost, the total cost of the premium for the employer, and then having employees contribute to one of their own personal HSAs. But by implementing this type of strategy that we're walking through, this is a way that you can not only increase the plan for the employees, but also lower the cost for the employer. And as Rob mentioned at the beginning, these HDHP plans promote consumerism. So this day and age, we see a lot of employees, they just go to whatever provider or whatever doctor or facility. And one of the biggest culprits that we see in this program, or not in this program, but rather out there in the marketplace is, for example, an MRI. You might be spending $2,000 for an MRI at one location and $1,000 for another. So by understanding consumerism and shopping around for those services, you may be able to save some of those HRA dollars that your employer is funding the employees and have minimal out-of-pocket expense. So when employers implement an HDHP plan, the employees are faced with paying that negotiated rate for medical services up to the high deductible. And as I've been using this example, $2,500 upfront out of their pocket to see providers. So as I was mentioning, the main difference here in implementing one of these plans is that instead of having copays for when you go to your primary and specialist and urgent care, whatever you may be doing, this program and these types of plans, you're paying the negotiated rate up to that deductible. And that's really where this strategy comes into play. So by pairing an HRA, employees get reimbursed a portion of that high deductible. So they potentially don't have to come out of pocket at all, meaning they're covering a portion of that deductible from day one. Worst case scenario, if you have an employee that's utilizing a lot of doctors and hospitals throughout the year, they're going to have a lot less exposure from meeting that deductible because the employer is covering a portion of that. So by employing this type of strategy, it's really a win-win because employees receive a portion of their deductible covered up front, as I mentioned, from $1, and they may not need to come out of pocket at all if they go to a provider or just need some prescriptions, maybe just a couple of visits throughout the year. They probably don't have to come out of pocket at all because they're getting reimbursed by the employer. And employers win in this scenario because when employees don't use any or only a few of their HRA dollars that have been allocated for employees, the employer is retaining that money and oftentimes are re-implementing that next year into this strategy. So let's take a look at some real numbers here on a program that we picked up, a new client that has never seen this type of program before. So let's take a look at what they were doing currently. So their traditional plan, as I mentioned, it was a very low deductible plan, and they were spending about $566,000 a year in just total premium. So as I mentioned, we're coming in with recommending taking a look at a high deductible health plan. And that high deductible health plan, just in premium alone, was $442,000. But remember, those high deductible health plans come with a large upfront deductible. But you're also saving, from a premium standpoint, $123,000 just in premium alone. Now, when we layered in and paired it up with the HRA, this company had about 68 employees in this program. So we were saying the deductible was about $2,500, or the deductible was $2,500, and they were reimbursing 50% of their deductible, which was $1,250. So we're assuming that every single employee is utilizing their full reimbursement allowance, that $1,250, which this is not typical. We have several companies that have this type of program, and we do not see employers utilizing all allocated HRA reimbursement dollars, every employee using those. Typically, what we're seeing, at least on our book of business, is anywhere from 20 to 40% utilization, and 40% being on the higher end. That's not common. So in the last column here, again, we're taking a look at that, still the same premium, right? This was what we went in and presented, that $85,000 worst case scenario. But they actually only utilized 26% of their HRA allowance. So when you combine those two, total was $464,000, basically saved $101,000 throughout the year, which was huge and significant. So you can see the difference between that $85,000 and the $22,000 is pretty significant, which they could use to either increase contributions in the following year, taking a look at what the renewal might be, and those types of things. But 26% is more on par with what we're seeing in the marketplace. So let's take a look at how this all flows and works from an employee perspective. So again, we're taking a look at this high deductible health plan, still using that same example of the $2,500 single deductible, $5,000 family deductible. As I mentioned with this plan, there's no copays, right? You're not paying $20 or $30 when you go to your primary or specialist. You're paying whatever the negotiated rate is between the provider as well as the carrier. So at the time of your visit, you have no out-of-pocket expense, because we're not sure what that is to be until your provider sends a note over to whatever carrier you're with and says, hey, John came in here and he saw, Dr. Smith, and Dr. Smith did this, that, and the other, and this is what we're billing. And that negotiated rate for the service goes towards that deductible. So again, it goes towards that $2,500. This particular program, the company was reimbursing their employees 50% of that deductible, which is the first $1,250 or $2,500 of the family deductible. So if you take a look at the flow here in the circles to the right, so the employee pays the negotiated rate for the visit. They submit that claim to the TPA, and then the employee gets reimbursed from the HRA through the TPA, that third-party administrator, up to that $1,250 or $2,500. So let's take a look at this case study just to push this point forward and take it home. So on June 2nd, I go to my primary doctor as I'm not feeling well. And after the visit, I get a script and I go on my way. But remember, you're not paying anything out of pocket for that time of visit, because you're paying the negotiated rate, and we won't know what that negotiated rate is until we receive that EOB. So I receive a bill from my doctor's office for $85, which is the negotiated rate between Dr. Jones and the medical carrier. And this could take some time for that bill to come in the mail. Typically, we see that EOBs are received much sooner than the bill itself. And as I mentioned, the EOB we also refer to in this program as the golden ticket, because that is really what dictates what you get reimbursed for. So you'll also receive in the mail, aside from that bill, you'll receive an explanation of benefits. And a lot of carriers this day and age, with being online and online portals, you'll be able to pull those down from your online portal as well. So you get your explanation of benefits from the insurance company showing Dr. Jones charged the medical carrier $200. So that's what they submitted for whatever you were there for. But the negotiated rate is only $85, which is what the bill says from Dr. Jones's office. And you always want to make sure these two match up. Sometimes there could be an issue, but you want to make sure your EOB and your bill match as far as what the negotiated rate is and what your responsibility is that matches the bill. So now you take that golden ticket, the EOB, explanation of benefits, and you submit that over to the TPA. And then the TPA will send you a direct deposit for that $85 into your checking account. In turn, you take that $85 and you apply it to your bill with Dr. Jones. So you mail him a check or pay them online or whatever the case might be, and you pay that invoice. So the sponsored HRA just paid the medical bill, so you didn't have to come out of pocket at all. And your employer is going to do so up to that 50% number of that $1,250 for single and $2,500 for family. So just to drive this point home, this is how, in essence, you would theoretically not come out of pocket at all for any medical expenses that you may, that may come out throughout the plan year, which really is a win-win for everyone here, not only for the employer by increasing how they're compensating their employee and reimbursing them, and also lowering the premium, which is a good fit for everyone because that's going to be less money that you're spending on your medical plan. But you're really enhancing it with this HRA strategy. So we hope you learned a little bit and hopefully take away a couple tidbits from this strategy. We would be happy to take a look at your current program and see the types of benefits that you're offering, or maybe considering taking a look at this type of option. And maybe we can make a win-win strategy for you. If you have any questions, feel free to type them into the chat box here. Also, feel free to shoot me an email directly. I'd be happy to answer any questions that you might have, or also give our office a call and we could take a call and talk through things and see what we could do for you. Again, thanks for your time. Hopefully this was informative for everyone. My name is Harry Bickle with Precision Benefits Group, and look forward to speaking with you in the future. Take care.